Investors should be wary of basing investment decisions too heavily on the plethora of economic data they're exposed to on a daily basis, such as GDP growth, interest rates, inflation data, amongst others. And this is as research disproves the existence of a positive relationship between real economic growth and stock market returns. To talk more about these findings, we're joined by Razeen Dinath from our Cape Town studio, and he is an investment analyst at ReCM. Razeen, thanks very much for your time. So let's put this theory into play and look at current markets where perhaps we should stay away from the stock market because economic growth does not necessarily flow into good stock market returns. China, for instance, is that an example that you would table?
Yes, well, if you look at what happened in China, for the last decade, China's had the best growth rate in the world at over 10%. And, you know, the starting valuation for China at the time, 10 years ago, was 0.6 price to book multiple, which then expanded to the current 1.6 price to book multiple. So China's generated great returns over this period of 19% per annum. But if you compare that to what's happened since 2008, when the price to book multiple was 3 and it's now re-rated to 1.6, the Chinese stock market has underperformed by 2.6% per annum, even though growth has also been around about 10% per annum. So the tie-up between the GDP growth and the returns you get is just not there. It all depends on your starting valuation.
Razeen, tell me, is your thesis really based on the fact that markets move in anticipation of a turnaround in economic growth, or is it that markets react post good news?
Yes, well, what we find is that you know, when people think that economic growth is going to be strong, they tend to extrapolate that into the future and they start paying quite high prices for quite a lot of the companies. And what you do find is when you pay a high price for any asset, the investment outcomes is just not that good.
You mentioned price to book earlier, and it seems that that is one of the measures you refer to. So what did you consider to be a fair price to book in markets across the world?
Well, most markets across the world over the long term is traded around about 2 times price to book multiple. For China, it's been slightly lower. For a long time, it's been about 1.6. For South Africa, it's also around about 2. So for most markets around the world, around about a 2 times price to book is about a fair multiple for the companies as a whole.
Razeen, would it be fair to assume then that you are finding opportunities in developed markets, although it is on a stock-by-stock basis? It's not because we're seeing a tough economic environment in the developed world.
Yes, well, I mean, the share prices have fallen quite a lot because of the tough economic environment. So if you look at what's happened to the French stock exchange, the Spanish stock exchange, share prices are down massively, and we are finding quite a few companies in those which are listed on those exchanges which are trading at very good prices. So even though the economic outlook's very dire, the actual underlying value of these companies is still intact, and we're finding good investment opportunities.
Would you be brave enough to go into Spanish banks at this time?
No, definitely not Spanish banks.
Let's turn our attention to the South African environment. What do you see panning out from a market perspective here? A lot of people saying we're close to fair value, notwithstanding the sell-off that we saw recently. Do you feel that there's still opportunities in the value space in South Africa?
Yes, you know, as a whole, the South African market is around about fair value. But we have found interesting opportunities, especially in the platinum sector. And, you know, everyone's going to say, well, platinum's, you know, a dog right now, and, you know, the platinum price is down in the dumps. But, you know, that's when you get the opportunities, is when these companies are having trouble. The economic cycle is quite low right now. The demand for platinum is not great because most of the platinum goes to Europe, where it's used to in the catalytic converters. And, you know, yes, the environment is depressed, but at the current share price, you're getting real good bargains in the platinum counters.
Razeen, just one other question then. In terms of sectors, the other one that I find quite attractive is the banking sector. What is your view on that?
Well, most of the banks right now in South Africa, we think are trading close to fair value or slightly above fair value. You know, the banks are good quality businesses in South Africa. There's basically 4 dominant banks which control the market. And, you know, we think they're good quality businesses, but at the current price, we just don't think there's that much upside in terms of your long-term return.
I want to jump back to the platinum story and explore that a little further with you. Your entry point into platinum, would it be Impala Platinum, or do you play Anglo Plat, or do you go for the mid-tier? Are you looking at the Northams, etc., Aquarius Platinum?
Well, our investment thesis on platinum is really that you've got the top 3 companies which control 70% of the platinum supply in the world. And these 3 companies have generated really good long-term returns over their investment life cycle. You know, greater than 30% per annum. And what you do find is that, you know, good quality companies do get cheap when the economic cycle is really bad. And these companies have good long-term track records. And because of the depressed price right now, the outlook in the near term isn't that good. But, you know, we've invested in Impala and we've invested in we invested in Anglo-American Platinum and Lonmin.
How do you feel about this platinum story? Should you not be buying into it? And I'm talking to Ashraf here, Razeen, in studio.
No, I'd agree with him on the platinum
Yes.
story. I think it's certainly the more attractive of the metals. It's underperformed in terms of its absolute price. I do think that the PEs are fairly high for the platinum counters, but that's because of certain factors that have affected them, such as the strikes at Anglo Plat, as well as the higher input costs. But remember, when those adjustments are made and you go to a normalized price of around, let's say, 1650 to 1700 per ounce for platinum, which I think is reasonable through a cycle, then you're looking at a PE in single digits. And I think on that basis, they certainly are cheap right now.
Razeen,
but you need to be patient.
Razeen, I've spoken to a number of fund managers of late that like the thesis that revolves around buying developed world stocks that have big exposure to emerging markets. Nestle, case in point, where 40% of the company's profits come from an emerging market, or 40% of the revenues from an emerging market. Obviously, being a developed stock, those prices have been under pressure given the economic environment. Do you like those stories?
Well, we do like those stories, and in our global fund we've invested in Johnson & Johnson, which is not as focused as Nestle on the consumer food side, but it's also a consumer products company. We just think that in terms of the value you're getting for the price that you're paying, Johnson & Johnson is offering more value than Nestle at this point in time.
Razeen, thanks so much for joining us. That's Razeen Dinath, investment analyst from RCM.